we will quickly turn to the second session, which returns to the traditional focus of lifetime income, which is annuities. Something that Moshe said in the discussion reminded me that RSP, we made an effort about a decade ago to get people to stop saying annuities and start saying lifetime income. And Mark Avery had this idea that people would have to put $1 in a jar every time they said annuities, and we would all have pizza, every month. It turned out we had lots of pizza. Old habits are hard to break. Anyway, Mark will present the first. Will present the paper in this on how to reduce regulatory barriers to annuities in defined contribution plans. Mark is known to everyone in the pension world, has many titles, wears many hats. He is currently visiting scholar at the Wharton School of the University of Pennsylvania and a non-resident fellow here at the Brookings Institution. And of course, he was the lead person at the Treasury Department for 8 years in the Obama administration on pension policy. His first discussant will be Phyllis Borsey. For many years, she served as the Assistant Secretary for Employee Benefit Security in the Labor Department, and obviously was a key player in all of the decisions regarding the issues we will be discussing this next session. Kelly Hewler will be our second discussant. She's the CEO of Hewler Income Solutions, which offers an independent platform for people to make annuity choices and other financial choices. So after the presentations, we'll get everyone up here and we'll continue the group conversation. So over to you, Mark.
Thank you, Bill. I would suggest that there's no more tired, shop-worn, hackneyed cliche in the retirement policy field than the old one about how the private pension system has shifted from defined benefit plans to defined contribution plans. We know that's not really right. Or at least it's not really a helpful framing of our understanding of what's happening. It's really not so much a shift from DB to DC as it is a shift from defined to undefined, from defined benefits and or defined contributions under employer plans to undefined benefits and undefined contributions, largely in 401ks and IRAs. From employer-sponsored, employer-designed, defined, designed, and funded pension plans that protect individuals from the risk of not saving at all, the risk of poor investments to some degree, the risk of inflation to some degree, longevity risk, maybe counterparty risk, over to savings arrangements that require people to take those risks, the individual to bear most of those risks, often without employer contributions, without employer contributions, or without employer protection from a lot of those risks and costs. A major casualty of this shift of risk bearing from employers and institutions to individuals who are the least able to bear these risks, and longevity risk, of course, given our ignorance of our ultimate lifespan, is perhaps the most difficult for individuals to bear. A major casualty of that risk shift is that loss of the solution to the dilemma that Richard described so well, that Bill haiku'd so well, and that we've been talking about thus far, between the need to protect against outliving your assets and the need to at least maximize in a reasonable way your standard of living and your optionality your liquidity. The solution to that dilemma, in part, has been, of course, guaranteed lifetime income, be it Social Security or defined benefit pensions. With the erosion of DBs and the shift to a saving system rather than a pension system, we've got much more liquidity, much less security, and yet for many savers, the ultimate outcome that they desire is income. That is, to replace their paycheck when they were working with a pension paycheck that is predictable, guaranteed, and adequate. After Social Security and DBs, the next most prevalent solution for guaranteed income has, of course, been this creature we've been talking about, the annuity, the financial product or contract offered by an insurance company, typically to an individual who pays once or over time in order to get regular payments, often monthly, for the rest of their life or for a term of years. And Moshe, as you pointed out very eloquently a few minutes ago, that's a kind of classic income annuity. But there are different kinds, and the use of the word is often confusing. We've got commercial life annuities that do pay income like that. We've got variable ones that don't guarantee a fixed amount, but will invest and provide a variable dollar amount every month or every quarter or year. And then we've got, as Moshe was just saying, the variable annuity that can pay regular income, but usually is not used that way. Usually it's used as an investment vehicle or an accumulation of assets vehicle that is tax preferred. So we've got immediate annuities, as Bill was saying earlier. We've got deferred annuities, the deeply deferred ones like this qualified longevity annuity contract, or QLAC, that we started when I was at Treasury a few years ago, could defer all the way to age 80 or 85. We've got single premium ones where you make one payment to the insurance company. We've got accumulation ones where you could make payments over time in order to dollar cost average the risk of buying your annuity when interest rates and therefore the insurance conversions of your dollar into a stream of income are disadvantageous. So you can spread that by buying it over a period of time. And you've got individual annuities versus group contracts. So the group contract concept brings us to this notion of having annuities in plans. An employer plan is a particularly apt place to lodge an annuity because you've got the group purchasing, you've got bargaining power, you've got fiduciaries who are negotiating the annuity on behalf of the individuals. You presumably will get institutional pricing, therefore, rather than the higher retail prices. And you'll get professional guidance if it's an ERISA plan, up to the point that ERISA would permit, and especially professional care and diligence and loyalty under ERISA to the people covered by the annuities. So why don't more people buy them? We've already alluded to some of these reasons, so I won't belabor it, but just to run down quickly, the list includes at least a dozen different reasons. Social Security might be enough of an annuity for you. Your family might be there to support you in the sort of traditional way. Interest rates are low nowadays, so it doesn't seem like a good time to buy. That's been true, of course, for years. Annuities can be perceived as having high costs, and indeed, again, to your point, Moshe, depending on what kind of annuity and where and who's selling it and so forth, the costs can indeed involve high commissions, high surrender charges, et cetera. And the distribution network for annuities traditionally is pretty elaborate. Brokers and agents, some people refer to 200,000 golfing brokers out there who are looking for families who might not otherwise buy an annuity, and they're actually putting their time in around the kitchen table to sell the idea that guaranteed lifetime income would be good. And then the question is, are they offering it on terms that are reasonable, and is the market working? And often, unfortunately, the market is not working so well, and the complexity, the non-uniformity, and the lack of transparency in the product features tends to defeat price comparison. You can't compare one annuity to another in many instances because the terminology for all the bells and whistles and features on the annuity is disparate. It's not the same. You don't even know whether you're comparing apples and oranges or apples and pears. Each one sounds different. There are behavioral reasons why people don't go for annuities. The wealth illusion, people think that when they've got an account balance, it's worth a lot more in terms of income than they really discover it is worth. There's what David referred to earlier, what if I get hit by the proverbial bus as I leave the insurance office having bought the annuity, and then all the money goes to the insurance company unless I buy a death benefit, which then dilutes the mortality credit transfers that Moshe was talking about, though not entirely. People don't see it as insurance. All too often they see it as an investment because it's being marketed very often as an investment. So that framing gets in the way. If they see it as an investment, they compare it to other investments and forget the insurance value of the annuity. And there are regulatory factors that impede the market here. Not to mention, by the way, the bias against insurance agents, against the insurance industry, all the syndicated columnists and financial columnists that have written negatively on annuities in the past, partly because they're referring to certain kinds of annuities, certain kinds of commissions and terms that not all annuities have. So we're going to focus on three regulatory problems. One, and the most salient, plan sponsors fear of fiduciary liability if they put an annuity in their 401k or other plan, and it turns out years later that the annuity provider, the insurance company, goes belly up. Second, the limited portability of annuities. And third, the required minimum distribution rules, which are a kind of brooding omnipresence on top of this whole area of lifetime income, even though they don't directly relate to annuities per se. So the first problem, fear of fiduciary liability on the part of the plan sponsor. Clearly, this nightmare of buying an annuity for my employees and then finding later that the annuity carrier is unable to make good on its obligations to pay the pensions is one that has haunted the corporate sector. ERISA counsel, in-house or outside counsel, have tended to be concerned that there is some liability to worry about potentially here when an ERISA fiduciary makes that decision to purchase an annuity for employees, whether they're giving it to employees or just offering it to employees as an employee choice. I do think that we absolutely need a safe harbor, and Bill and David and I and Victoria believe that whether or not that fear on the part of the employer is exaggerated, and I do think it is exaggerated. There's a statute of limitations, as Phyllis has pointed out, in ERISA. There are other reasons why this is magnified. And whether or not the employer, a given employer, is using this as a pretext for avoiding the trouble and extended conversation involved in engaging in an annuity purchase, or whether they're truly deterred by this, and if this fear went away, they would actually move forward with an annuity. We've got both kinds. A fiduciary safe harbor is absolutely necessary. ERISA expects each plan, since there is no safe harbor at this point, to do its own independent assessment and analysis of the insurer's claims paying ability or financial strength, and the typical recourse is to hire a consultant who's expert in this area to advise on which carriers are a good bet, are prudent choice under ERISA for the employees' pensions. The idea of a safe harbor is to streamline the process and give certainty so the plan sponsor and fiduciaries know if I do these 3 steps or if I walk through these 6 elements of a kind of recipe, I'm done. There's no uncertainty about it. It's not going to be ambiguous. It's clear and crisp. And so our view is that that is the way to go, to have a safe harbor that streamlines the process, that provides certainty, and that reflects the analysis that fiduciaries normally go through. That is, what is the financial strength of the carrier? How sound are they? What are the terms of the contract? What is the cost, et cetera. Without some quality standard looking at the financial strength of the insurance carrier, we think that you could be looking at a variety of insurance companies, some of which may be below investment grade in their credit ratings. And even though we do have state regulation and a state guarantee association system, which need to be very much kept in mind, we think that if we were starting a safe harbor, constructing a safe harbor from scratch, we would use a financial strength criterion that is not fuzzy. It's not the current law, which is you have to analyze it and do tremendous amount of due diligence in comparing carriers and their claims paying ability and their other attributes, but would be objective and clear. So rating agencies, do they have, let's say, 2 ratings from major agencies that are at least above a specified level, and maybe no ratings below a different specified level? Now, there are pros and cons here. The rating agencies got a huge black eye in 2008, blamed for part of the Great Recession, for overrating certain famous derivative-type products. They're not entirely free of conflict. They do ratings typically for companies, insurance companies that pay them to do the rating. There are all sorts of issues there of independence, but in our view, the question is, what's the alternative to using the major rating agencies' ratings as at least a major part of a safe harbor? The precedents are there. Labor regs used to use the rating agencies as one factor to take into account in assessing the strength of a carrier under ERISA. The market does this now in all sorts of ways. The Fidelity website, for example, has an annuity selection, and all those carriers that Fidelity is showing have been checked out by Fidelity, but the one thing they tell you after the name of the carrier is its ratings by the major rating agencies. And they're all well in the A range, A and above, on Fidelity's website. You could have legislation, alternatively direct Labor Department to figure out exactly how to construct this criterion, perhaps in consultation with Treasury's Federal Insurance Office, with NAIC, National Association of Insurance Commissioners, the Academy of Actuaries, perhaps, and other sort of neutral, respected organizations. Is there an alternative to using the rating agencies? Well, certainly the expert consultants are the current alternative, but does it make sense for every 401k plan who's interested in having an annuity have to hire its own consultant to assess the self-same issue. How strong financially is X insurance company or the following 24 insurance companies? Socially inefficient. You could have, if you didn't have a rating criterion in a financial strength safe harbor, you could at least have some single entity that pulls together this assessment of the insurance industry and provides their judgment as to whether it is prudent. So if you look at other precedents and recommendations, the Bipartisan Policy Commission, even or including the Trump administration Treasury, which issued a report in October of 2017 on this, they have also looked to the notion of either rating agencies or some objective other third party, which could be created, that's maybe more independent than the rating agencies. Another option would be simply, at a minimum, if you were to say, Congress has already made its decision, the legislation is on track, we want to get legislation enacted now that has a lot of favorable provisions, RISA, Secure, and Martin Bailey, Ben Harris, and I have written separately about that legislation. It's on the website. We want to get that done. There's a fiduciary safe harbor in that doesn't have financial strength ratings. It has regulatory approval in the normal course by the states. If this would hold that up, is it worth it? We are not making a political judgment here. We're saying if we were designing a safe harbor from scratch, we would include financial ratings. Many of us are very much in favor of getting that legislation passed so that it's a different question what is politically feasible to change, if anything, in the legislation now. If you just disclosed ratings in a very conspicuous compilation and one nonprofit party put that out, here's the major all the carriers, here are their ratings, publicly available information on from the various major rating agencies. That could by itself help even where a safe harbor has no, legislative safe harbor has no element of financial strength, comparative financial strength in it, and that might develop on its own in the market. I would also note that there is a possible related safe harbor that one could add through legislation, whether now or later legislation, that would provide a safe harbor to put an annuity into a plan as a default, that is a qualified default investment alternative, QDIA, codifying the guidance that Phyllis Borsey and I developed when we were at Labor and Treasury during the Obama administration. Right now, the guidance takes the form of a Treasury ruling and a letter from Phyllis to Mark, which we thought would move the market. It could be elevated perhaps a tad, maybe a notice and comment regulation. Phyllis and I would not regard that as a step up necessarily, but the market might. So we would recommend that as well for embedded annuities, to put an annuity in a target date fund as the fixed income exposure of that fund, and then eventually, after lots of warnings, they get the red envelope that Moshe was describing. Now you're in it, you could get out of it until now. And that warning could be when you're retiring. The other quick points I would make here are that there's a portability problem with annuities. It's readily solved. If you have one in a plan and the plan stops offering it, the record keeper stops or is changed, what have you, you can't get it out of the plan to continue contributing to it. We could let the rules allow a specific exception for this as a rollover to an IRA so the person can continue to contribute, provided it's not abused to just do this for one or two senior people as opposed to unavailability that's truly unavailable for everyone. The other issue I would quickly touch on is that the RMD rules, required minimum distributions, age 70 and a half, you have to start taking not taking your money out of savings, but taking your money out of tax-favored savings, out of the retirement plan or IRA, and putting it into a taxable account or consuming if that's what you want to do. Those rules are not a well-targeted regime. They are intended to prevent tax deferral from going too far, basically estate planning, people who are very well off and would want to just postpone taking the money and leave it to their heirs. Most Americans are not in that category. We therefore would propose a radical simplification of the RMD rules, namely to totally exempt the smaller and the average saver from these required minimum distribution rules, which can get complex, which have a 50% excise tax that's pretty scary, hanging over a lot of the elderly people in this country. And we proposed something like this when I was at Treasury in the Obama administration. Chairman Neal, who is the Ways and Means Chairman, and I think the Tax Writing Committee Chairman, who in all of our history cares more about retirement savings and retirement security than any other tax committee chairman, Senate or House that we've ever had. He's proposed something like this, and the Republican House has proposed this kind of legislation when they were in the majority late last year. This should cost less revenue than one might otherwise think, because regular folks with small accounts cannot afford to let the money build up forever on a tax-deferred basis. They need to live on it, so they're going to take it out anyway, and it's going to be taxed anyway. We have a number of other proposals. We'll save those for the discussion period, but we're hoping that the kinds of things we're talking about here will help restore the pension to the private pension system. Thank you.
Good afternoon. I guess it might be afternoon by now. We're sort of on the cusp. First of all, I want to thank Brookings very much and Bill for inviting me to participate in this discussion. When I left the Department of Labor, a lot of the reporters, did exit interview kind of things. And most of them asked me what I was proudest of, and most of them asked me what unfinished business I left behind. And what I said to all of them is, because of my longstanding interest in guaranteed lifetime income, this was actually a topic that I was very disappointed that I wasn't able to bring farther along. And so I do appreciate the ability to talk about these issues today, and do hope that the discussion continues, because there's a lot to say, a lot of great ideas out there, including a number of them that are in this paper. I want to try to pace myself, because the hardest thing for me to do is to keep it to 10 minutes, because there's so much to say. So I'm going to talk mostly about the annuity safe harbor, because I want to share with you some of the thinking that went on at the Department of Labor as we considered this, because we spent a lot of time on it. And then I just briefly have a couple of comments, primarily on the required minimum distribution, as somebody who's had to cope with those. I have some great suggestions of how to make it easier for those of us who are old enough, over 70 and a half, and have to take these things. So let me start with the first topic, which is how do we encourage more plan sponsors to offer opportunities for their DC plan participants to select guaranteed lifetime income options. There is no question in my mind, for my 40-plus years in the business, that the most important actor in this, on this scene is the employer. The employer is the fulcrum for helping people to navigate their choices. There's clearly a need for a safe harbor. I agree with that. I think there is some disagreement as to how it should look. I don't think the disagreement actually is from a policy point of view. I think it's from a business point of view, a revenue point of view, a market share point of view. Let me talk a minute about, what's a safe harbor? Mark actually talked about the need for clear and crisp conditions in a safe harbor, so you check the box, boom, 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 and you're off the hook. That isn't happening. A safe harbor is designed to protect people that are the beneficiary of the safe harbor, but one of the reasons in 1975, on my first day of law school, that I concluded that I wanted to work in the ERISA area is because nothing is clear and crisp. And if people tell you that is the truth, they are either uninformed or lying. And I don't know which is the worst. But the purpose of a safe harbor is to point people in a direction that shapes their due diligence discussions. I agree that we need a safe harbor, but it's not as simple as 5 little checkpoints. And a poorly designed safe harbor is actually less useful and more dangerous to plan sponsors than a safe harbor that helps you narrow your choices, helps you do your due diligence, but in a way that doesn't protect only the plan sponsor, but also protects the participants. And that, to me, is the greatest disappointment and weakness in what the current legislation has. I won't be, my politics are my politics. This is not political because we have misguided Democrats who support this as well as misguided Republicans. The current safe harbor that Congress is considering, I wouldn't call a safe harbor. I would just call it a ratification for anything, any insurance company or any insurance product that isn't a bottom dweller in the marketplace. It is designed to be very protective of plan sponsors because it basically says you can select almost anything unless the insurance company is under investigation by the state insurance department. You can select any carrier and you can offer them any product, and plan sponsor, you're off the hook. The plan sponsors that I know and that I have worked with have not spent their lifetime trying to help their participants have good, solid retirement income, only to throw it away by offering a substandard product. The notion that we ought to have a safe harbor is a good one, but the safe harbor needs to be focused more, as the paper suggests, on financial solvency, the financial strength of the institution. When I was in private law practice, and actually one of the flaws or one of the disadvantages of being in the benefits business is friends and family often ask you for advice. And when people ask me for advice on how to select an annuity, either an individual annuity or plan sponsors would ask about selection of annuities that they wanted to offer to their employees, I used the mother rule. And Professor Thaler referred to this in his remarks this morning. The mother rule is very simple. If the alternative to providing a good, solid annuity for your mother is that she would forever live with you, would you select this carrier and this product? And the mother rule retains its good stead to me and millions of other people. The safe harbor in the legislation, and this is the last thing I'll say about it because it pains me to even talk about it, flunks the mother rule. So if we were designing a safe harbor, I think the criteria in the paper make perfect sense to me. We need some sort of financial strength test. And at the Department of Labor, when we looked at this issue, obviously the first thing we thought about is to bootstrap on the existing credit ratings. There was a significant problem, however, and that is illegal under Dodd-Frank. a provision in Dodd-Frank directed federal regulators to remove from all of their regulatory pronouncements, whether they be notice and comment rulemaking, other kinds of guidance, any reliance on credit ratings. And it was, as Mark pointed out, because there was such distrust of the behavior and the ability of existing credit ratings at the time that rating agencies at the time of Dodd-Frank to adequately deal with these issues. So that was off the table. Believe me, we tried. We tried every euphemism in the book to figure out if we structured a safe harbor, could we use a credit rating? Because one of the other issues for plan sponsors is if you're going to have a safe harbor and you're going to say you need to have these particular, these are the measures, the metrics of financial solvency that you need to look at, you need to have them publicly available or easily available sources. So it doesn't take the plan sponsor a lot of time and effort and money to be able to identify the strongest companies in the marketplace. So ideally, Congress would change Dodd-Frank and put credit ratings back on the table. But the paper, when you read the paper, you will see that the authors of the paper have done a terrific job at setting out other measures, other metrics. So I do think that financial solvency is the way to go in terms of structuring a safe harbor. The point of the safe harbor is to narrow down the due diligence decision, not to let every product in the marketplace through the safe harbor. There is one suggestion, however, I would make to the paper, and that is, and this comes out of the work that we did in conjunction with the conflict of interest rule. I think in terms of a safe harbor, which is to reduce the need for plan sponsors to do extensive additional due diligence, I think the type of products that would be eligible for safe harbors, you know, the financial solvency and financial strength helps narrow down the insurance companies whose products would be available. But I do think for purposes of safe harbor, it ought to be limited to products whose sole purpose is to provide guaranteed retirement income. You know, as regulators, the question we always ask is, what's the problem you're trying to solve? And the problem you're trying to solve here in creating a safe harbor is you want to protect against insurer insolvency, and you want to make sure that people have the opportunity to select a guaranteed lifetime income product. And the problem in the insurance marketplace is that there is a proliferation of products that have other objectives. So I would limit any safe harbor to immediate, deferred, or longevity annuities. You can have, if the plan sponsor wants to offer variable annuities or fixed indexed annuities, that's fine, but not within the safe harbor, because then you'd have to have enhanced due diligence to see whether those products that aren't designed primarily to provide guaranteed lifetime income may fit. Okay, I'm more than out of time, but let me just give you my idea on required minimum distributions. You know, IRAs are not required to provide a required minimum distribution. They just have to tell you that it's available. And that, for me personally, and for millions of other retirees, causes a great deal of confusion, particularly in the first year that you're eligible. I think the rule ought to be the same for distributions, whether it's an IRA or not. And actually, I would defer to Professor Thaler's idea that distribution of the annual required minimum distribution amounts should be automatic unless the person opts out. And then we could have a long discussion about how some need for tax withholding, mandatory tax withholding is the same. But I'm going to stop because I'm way over time. Thank you very much.
Well, we're not afternoon yet, but we're getting close. Thanks for all of you staying so patiently. It's always an interesting exercise to be the last person after all of this amazing information has been bantered around. I want to thank Mark very much for inviting me. I'm Kelly Hewler. I think David mentioned I'm CEO of Hewler Companies. That is not a household name, so let's just put that out there. And I'll give you a quick understanding or introduction so that you know how we fit into this picture. I'm not a regulator. I have great admiration for Phyllis and Mark and the things that they've done, and they know that I've been a soldier in the lifetime income effort for really the better part of 2 decades. So I'll just tell you quickly that I founded the firm in 1987, and our sole responsibility was focused on helping employers, fiduciaries, sort of satisfy the needs around selecting and procuring contracts for their defined contribution plans in the insurance side. So you may have understood it as in the day GICs. Today, that would be considered stable value. So we cut our teeth in working side by side and standing shoulder to shoulder with the fiduciary decisions that needed to be made by the large employer to protect and ensure appropriate delivery of insurance products into their plan. That taught us just about everything we needed to know about the insurance industry in terms of structure and contract structure, but also how the whole purchasing process worked. And I was actually asked in 1999, many years after starting the firm, to come to Japan and speak on the role of stable value in the defined contribution system in the US. And it was at that meeting that I had the opportunity to spend a couple of days meeting one-on-one with Japanese insurers. And if you can all think back, in '99, we were looking at 0% interest rates and a rapidly aging population. And the Japanese were struggling mightily to try to create, I would say guaranteed is a good word, but stable and sustainable income for their people into the future with this massive wave of retirees and folks that were facing 0 interest rates. That was really the point in time where the longevity light bulb went off. I just never had thought about longevity and the payout side of what we were doing. It was so focused on doing what needed to get done to create the benefit of stability inside the plan. And that was really my moment of conversion. That was my moment of, aha, we are a system that is lacking in addressing the payout phase and distribution of these hard-earned savings that are accumulating in our private retirement system. So that's my background. As part of that and how that relates to the paper, Mark and I have had great discussions about this, and he knows how deeply I admire his work. And we agree that there are some very critically important points of discussion in that paper. We also agree that the legislation that is moving and that has made tremendous progress to date, it has taken a yeoman's work and effort, and we're very thankful to Congressman Neal and others that have worked on that. And at this point, I can tell you from working this many years with plan sponsors, you really have to recognize that we are not going to get much further without a safe harbor. It's just not going to happen. And we can all debate what's good and what's better. And Phyllis, you point out eloquently how you view that. Help me with this. Can somebody give me a... There we go. But here's what I want you to think about for a moment. Today, we are losing assets at a very rapid pace out of these plans that are rolling over to create lifetime income, sustainable lifetime income elsewhere, because employers are so concerned about selecting the insurer and without a safe harbor. So if you think about what employers are doing today for their employees to create a place to invest safely with all of the benefits of the fiduciary regime around it, and we are losing dollars rapidly, and we're losing it to what I consider to be very predatory practices on the American public. We see it every day. We see retail products being sold. How many of you have been invited to a steak dinner lately? how many, I'm 60 this year, so I cannot tell you how many hello to my husband and to me, please come and meet with us. We would love to talk to you about your financial security. I bet you would. So I just want to put this out there as we go a little bit further. And I want to say that I'm a huge advocate of standards, and we have practiced standards from 1987. I'll tell you that the standards we put in place definitely begin with investment grade. That's the way we cut our teeth in this business. That's how we understand the fiduciary responsibilities. And we put together a practice of examining both the insurance company in its current form, but in terms of ongoing efforts to follow, to review, and to continuously update our understanding of the insurers we were dealing with. And so we have a very tried and true, time-tested approach to this. We spend tremendous amount of time and resources. We look at this and we believe that insurance company selection is a critical component of what a fiduciary needs to do, but it is not the only piece, and it can be done in a variety of ways. So we think about it a little bit more in the context of the whole picture and driving ultimately not just the selection process, but as if I'm a fiduciary, and I said to Phyllis this morning, you know, whether or not the fiduciary rules were finally and formally enacted, that regulation and that determination has changed the view of many in the industry to the benefit. And whether that was enacted or not, Hewler was never going to change the way we did things because we had standards in place already. We believed in the no conflicts of interest, no pay to play. We believed that features must be fee-leveled and feature-leveled. And I remember having the first conversation at the department. I said, yes, we do that. Because we do that because in order to have comparability, you have to have standardization. So while issuer selection is a key piece of what we believe fiduciaries do in this area, we look at all these other factors and competition, transparency, low cost. So when I showed you the previous slide and wanted you to think about what's leaving the retirement system, remember that the retirement system is one where costs are kept low, they are transparent, they are driven lower by competition, and that's not occurring on the individual level. When we look at what people compare the income levels they can earn through our program or a program like that, there are many different alternatives available. But when you reduce cost, you create competition at the point of purchase, and you are working with a high quality stable of carriers, you can produce far better outcomes for employees and for participants and retirees. So when we look at, we try to say, what is the average that we see in our data? And that's around 5% on a SPIA, that someone actually increases their monthly payment or decreases the amount of money they would have to take from their savings to achieve the same level of income. And that can go well into the double digits if you're talking about deferred products. So when you think about the practical realities of this, getting employers to the point where they feel free to offer programs that are institutionally structured and can be married with their investment programs, to us, that's the future of where we need to go. And we believe that the private market, as Mark suggested, possibly some of these things will occur in the private market. There's a couple of things I would say. I think the greatest benefit comes to the participant and the public when the private market collaborates with the regulators and the legislators to say, what can we get done in the most practical way without ever forsaking the reason that we're here, which is the participant. And at the end of the day, what we're doing is to benefit the retirees. But I have to tell you, I'm a believer in perfect not being the enemy of good. And we all have to recognize the practical realities. We are a small firm. We are not a household name, but the firms that we work for, the fiduciaries we work for, are household names that you would know every day. And the reason they come to us for those services and capability is because we recognize that the fiduciary wants to do the right thing and needs resources to be able to do that. And we've created a system where, and you might say it's not actuarial fair, I would say it's actuarially very fair. And if we study our pricing variability studies, which we do all the time, using a framework that helps drive cost and unnecessary bells, whistles, nonsense out of the process will always produce a better result for individuals. And the one thing I would say is our bias is towards not a single issuer solution, because you can't get comparability. When you have a single issuer, you're really never able to create that comparability that both the consumer and the fiduciary should be thinking about. So I think I'm really getting close to time. I also wanted to say that the independent fiduciary concept that, Mark, the paper, I value that, because I think independence, you can't be a good fiduciary if you're not independent. If you are not willing to rid yourself or your system of the conflicts, you can't be a good fiduciary. But I think that model, and you propose one model, we look at ourselves as another example of that model. And I think that you mentioned putting credit ratings and other things and keeping the transparent. We believe that you can do that if there's no pay to play. And you can do a better job of it if there's, truly a distance from the product providers. But don't forget, the product providers are an essential part of the process. They are stakeholders at the table, and we have to figure out a way to collaborate and bring the best possible results of our thinking, of our innovation, and ultimately of our capabilities to deliver it with an employer into the plan for the benefit of the employees. I'm done. That would be my comments. Thank you. Do you want us up? Okay. Yeah, thanks.
All right, great, thank you. Thank you all. We want to turn to audience questions, but before we do, let me just ask you briefly, Mark, is there anything that Kelly or Phyllis mentioned that you wanted to respond to or clarify?
Well, Bill, I'm, excuse me, very appreciative of those really thoughtful and very independent comments from both Phyllis and Kelly. I would say that we are approaching this from two standpoints, and this is not unlike our normal approach at Brookings. We are independent. We're trying to look to what is the best policy, and we're also practical and looking at what the impact of our views and our writings would be. And so from one standpoint, the research and the analysis that we've been doing ask the question, if we were designing a safe harbor, first of all, do we think one is necessary? Yes. Number two, how would we design it? And that's what much of this paper, and by the way, if you're wondering about the two papers you've heard about, they are forthcoming. They're not available out on the table, excuse me, today. We decided we would do them in draft and then revise them based on the discussion and comments today. So they'll be coming out soon. Look on the Brookings website for that. The second approach is given where Congress is today, where the process is today, what is practical and realistic. And I'm not suggesting that it's necessarily impossible to make changes in legislation that's been proposed, but I defer to Congress to a great extent on what is possible, what is practical. And I do identify with the point of view that the legislation of which this safe harbor is just one part. We've got MEPs, multiple employer plans encouraged. We've got disclosure for annuities. We've got a portability provision. We've got another couple of dozen, mostly very good provisions, good policy, and good for for the workers and retirees. So I'd like to see that pass. And there's a difficult balancing act between, as Kelly alluded to, between what one thinks would be best if one were writing this on a clean slate and what Congress is going to be able to do. So I would suggest, if Congress is not in a position to change the safe harbor the way it is now moving through Congress, and God bless Chairman Neal for his role in getting things, helping things move through Congress on a bipartisan basis and setting such a tone of civility and bipartisan cooperation and getting things done. Then maybe after the legislation, maybe regulations can help shore up the safe harbor. The market also may be able to work. ERISA counsel on the part of, for the plan sponsors will be concerned about preventing litigation. They'll want certain standards to be recognized whether or not they're in the safe harbor. Potentially the consulting firms will still be in the act because the safe harbor, I would guess, will not be such that you won't have employers going to a consulting firm and saying, so how do I narrow down the field of all these insurers that qualify under this very liberal safe harbor? So, Bill, that's my sort of comment, that I think we have to look at it both ways. And when you look at it in terms of what's possible, if you don't think the legislation is going to change, if you think Congress has already set its course on this safe harbor, then our paper has addressed what can we do, what can the market do, what about disclosure of financial strength ratings? Should it be required to the individuals who are getting the annuities? Should it be required in a conspicuous way to the plan sponsor that's choosing?
All right, thank you. Let's turn to questions from the audience. Gentleman behind, right there with the scarf.
I want to ask a question of Professor Taylor to your comment about issuing a security that's tied to Social Security benefits. Interestingly enough, Professor Merton and I have recommended the creation of a bond we call selfies, which I've discussed with Mark and Bill as well, where the US Treasury issues a bond which pays $5 real starting when people turn 65 for, let's say, a period equal to the average life expectancy. And what that's meant to do is to basically make the calculation of retirement income extremely trivial to your other paper on financial illiteracy, because most people can't do the basic math that they need to do. So the idea would be US government issued, starts paying $5 real per year for, let's say, 20 years, so it's priced by the market. But rather than just indexed to inflation, which we've heard about here, Professor Merton's point is that it should be indexed to standard of living, because that's the true risk of retirement. It's not just inflation. So I'd be very interested in your thoughts on that.
This is actually closely related to what will be my first question for you in the next session, so let's hold off until then. Okay. Other questions? Yes.
Howson Brookings, GS. So I'm just since the panelists has already touched upon the regulatory perspective of annuities, I'm just wondering, like, should the investment management of annuities should be like the public pensions have some like investment restrictions regarding like how to design the portfolios, and also related to that, how closely do you feel the portfolio should follow the modern portfolio theory or the efficient frontier? Yeah, thank you.
There's a question for Kelly. Kelly, how do you solve for the problem of using unisex mortality tables within a plan as opposed to using sex-based mortality tables in an IRA? I mean, that really doesn't cause some kind of adverse selection. Like, why would I ever annuitize out of a plan when I would get a larger, more inexpensive benefit by annuitizing out of a IRA?
I don't think there's one way to annuitize. I think Moshe, you said that. I don't know where you went, but you were here. Said that earlier. There's not one way to annuitize, and I think Michael was referring to the disparate needs that people have at retirement. And I don't think, oh, there you are. I was just saying you were referencing something and I couldn't find you in the audience. But we don't see it as an either or. We work with employers that have both. And there are elements of an in-plan annuity that can be, and we actually have a client that allows there to be a rollover into the DB plan so that someone can actually use the DB plan. And our role isn't to say this is better or this is worse. It is to say what are your needs and which solution is going to fit you best. So I think maybe that either or mentality, one is better, one is worse. If a plan sponsor has something in the plan, then they're never going to offer something outside of the plan. And I think to Michael's point about there being a whole variety of needs, remember too, we see people who have spouses that don't have any pension coverage at all, and they can't get a hold of that in-plan option. So they use the other platform. So yes, there is sex-distinct pricing that occurs in the aftermarket, and there is gender-neutral pricing that is occurring in the plan. But I don't see it as an either-or, and I think we have to open up our minds to the reality that people's lives are very different, and if we give them more to choose from, they may be able to reflect their household in these decisions even better than with just one.
I moved a little too quickly before. I think Phyllis wants to respond to the previous question.
I'm sorry. I was feeling badly that we hesitated too long. I think I was having a hard time hearing you. And so I think, was your question about relevance of modern portfolio theory? Was that it?
Yes, actually, it is like a two related questions. The first one is regarding the investment management of the annuities. So whether there should be some attached investment restrictions, like in public pensions, which is part of my working dissertation. And also regarding things related to, there are going to be some investment restrictions. So that's why I'm wondering, like, how will that, how will the portfolio of annuities will closely follow the efficient frontiers, or also known as the modern portfolio theory? I hope this clarifies my question.
So this question about whether there ought to be restrictions on investments or not is, well, let's see. I've been in the business for 40 plus years. I think we've discussed it every single year. The position that ERISA, that was taken in the statute, is that the duty of prudence, and it, obviously you have to have prudent investments. The statute doesn't put any restrictions on what is, it doesn't define prudence, it doesn't put any restrictions on this type of investment or that type of investment. And it does so because that's the job of the fiduciary, to look at the facts and circumstances, if you will, about the plan, its funding status, its investment objectives, the needs of the participant, the demographic criteria, and it's up to the fiduciaries. This goes back to Mark's clean and crisp. There's no clean and crisp set of rules for fiduciaries. And over the years, there have been a variety of legislative and regulatory proposals that have tried to constrain fiduciary discretion. And I think that probably the modern portfolio theory, I happen to think it's still relevant, and I think it does provide a decent enough framework. It isn't as detailed as some would like. I mean, for instance, I see Josh Gottbaum here, who's very familiar with the problems that PBGC is facing, and there have been proposed solutions over the years that would try to limit the risk to PBGC. At least this is the purported goal of the solutions, by saying to pension fund fiduciaries, you can invest in quote unquote risky investments. Of course, risk, like beauty, is in the eye of the beholder. And so it's really hard to, the statute doesn't encourage specific restrictions on investments. It's left to the duty of prudence and loyalty that all the fiduciaries have. But the question you ask is a question that comes up many, many times in policy discussions, both at the the federal and state policy level, and as someone who's represented individual trustees and been plan counsel, it comes up at virtually every trustee meeting that I was at when the investment manager gives his report or the investment consultants do. But that's an excellent question.
So let me just add, without disagreeing with anything that Phyllis just said, my own personal view is there should be much more maturity matching and much more restrictions on the investment to correspond to the liabilities, to the structure of the liabilities, because every time there isn't, the government gets left holding the bag.
I agree with you as far as a strategy. I think that where we disagree is whether it should be mandated by law or not. And by the way, that's the point of a safe harbor, as I tried to say, maybe not very articulately, that the point of the safe harbor is to put some restrictions on, because to the extent that you get relieved from some liability by using the structure of a safe harbor, that the quid pro quo is the restrictions on the safe harbor.
Right. David.
David Wentworth, tax policy consultant, but I also used to work for the insurance industry, and I know that a major problem the industry faces has been hinted at by a lot of the conversations, but nobody's addressed directly, which is everybody agrees that nobody really likes annuities, despite not being clear what annuities are. And a primary reason is adverse selection. The people that buy annuities tend to be the ones that have reasons to think they will have live long lives, and they also want their money back in the rare case that they get hit by the bus. I haven't yet heard anything that really addresses that problem. We've got safe harbors, maybe, various things, but how do you address the fundamental issue that if it's voluntary, you don't have a diverse population buying annuities, and therefore the annuities get very expensive?
There are only two ways to do it: mandates, that hated word, or or create incentives. It's a carrot and stick. We have a carrot and stick system, and so to encourage and see, I agree that the word annuities, we ought to strike it from our vocabulary, because it mushes up a million different concepts. What I think is an annuity is actually an investment vehicle sometimes. So I think the marketing has confused both plan sponsors and individual participants. I prefer to call it a guaranteed lifetime income product. And the way to encourage it is to make, to the extent that the paper and other research indicates that plan sponsors are reluctant to add guaranteed lifetime income options as a distribution option, then we need to figure out how to make it more attractive for plan sponsors to offer it. I mean, the irony is the work that we did at the Labor Department, to the extent that it's one of these things where to the extent it's offered, nobody takes it. And nobody takes it, I think, is what you're alluding to, because of all the reasons that Mark in his paper and then on his slide said. So I think we need to change the notion that, I think by changing the marketing slogan or the name, we can maybe get across what the point of what we're trying to do is, which is to encourage more lifetime guaranteed income.
Yeah, I think I'm going to add to Phyllis's comments and say, really, we haven't done a fair job of giving people the alternative to accept lifetime income as part of their overall payout strategy. The traditional method was all or nothing. Here's your offering, you take it, all of it, or you take all your money. Remember what I said earlier? Knock, knock, knock on the doors. Everybody, your brother down the road is a broker. Do you really think that people are going to give all their money back to one thing? It's not going to happen in today's world anymore. It's not happening. So it's been a failure. But I think if you start to see, and we're starting to see, when there is engagement about the issues that people are concerned about, longevity. I don't know how long I'm going to live. My mother lived till she was 95. My father died early, but I have no idea. I like certainty. Moshe, I think you said that earlier. Some people prefer that more than others. But there's another piece of this, partial. We have not given people the alternative to take a small percentage of their resources without having to go through these tremendously complex, decision-making matrix and just offered it to them as part of the natural flow. We call it creating a default-like path, because you aren't going to default people into irrevocable things easily, even if we have a safe harbor. There's a lot of issues around that. But if you create a default-like path and we change the way, you say, change the name, change the way we message, change the way we frame it, I think in 10, 15 years, we may have a very different experience.
All right, let me thank all the panelists. There's excellent discussion, and thank you, and ask you all to step down.
Thanks for watching. Be sure to like and subscribe for more videos from Brookings.